We are in the car road tripping. We are on the way up north to see our grandma, who is 97. We've not seen her in a while, so we're making an effort to go and see her. This is my identical twin, Claire.
Hi.
Tell them who you are.
I'm Claire. We only recently found out we're identical. We got to 36 and nearly 37 years of age when we decided to do a DNA test to determine that we are in fact identical. So I am a solicitor and a partner at a niche family firm in Gravesend called Stanton Solicitors. I'm also a notary public for all of your worldwide needs. That's basically me in a nutshell. I am married, live in Meckham with a 2-year-old German Shepherd puppy.
So we thought, while we're doing this trip, why don't we take some time to have a chat? Claire's going to ask me some questions about finances and money and anything that's on her mind, and hopefully it'll help you guys out. So yeah, fire away, Claire.
Okay, so this is completely off the top of my head. I have no idea what I'm going to ask, and we're going to probably jump from subject to subject, from category to category. Who knows?
Sounds scripted, guys.
It does, doesn't it? Planned. Okay, number one. Lou, what's happening with interest rates in the next year or 5 years? If I need to maybe think about investing or switching my mortgage, would I be a bit daft to fix now for 5 years, or would that be a really sensible idea?
Well, Claire, that's a very good question. Interest rates are currently at 5.25%. That's the Bank of England base rate, and they're probably going to stay there for a little while at least. There were talks it might go up again, but because inflation has come down to 4.6%, the government have achieved their target of halving inflation before the end of 2023.
Yep.
So interest rates may well stay at 5.25% for the time being. They might go up once more, we don't know, but hopefully they won't. In terms of lowering, they'll probably start lowering in spring next year, and it'll probably be quite a long, process of lowering rates, slowly but surely over 2024, and then hopefully by 2025 we'll be back to nearly 2%.
Okay. So
in terms of a mortgage, do not fix. Do not fix. If your mortgage is coming to an end, do not fix. Stay on the standard variable rate for the time being. I know it's going to be expensive, but if you fix now and rates do indeed drop next year, you're going to be stuck in a really high interest rate mortgage for 2, 3 or 5 years. So if you can, stick on your SVR and just try and ride it out for a little bit, and then hopefully you could look at a lower rate later on next year.
Fab. And what do we think the chances are, if any, of getting back to the interest rates we saw during COVID of sort of 1.25, 1.5%? Are we ever going to see that again?
Very slim and very unlikely, I would say. Obviously, we had those interest rates for a reason, and we had them for a long time. But ultimately, we're now at 5.25% base rate. So the likelihood is we'll start to get back to closer to 2% maybe in 2025, 2026. So it's unlikely we'll get back to 0. whatever percent anytime soon anyway.
Okay, thanks. Right, now where we're going to go? Oh, let's go to investments versus debt. So Lou and I have had this discussion before, because obviously she's my twin and my IFA, so I could just ring her randomly and ask her any question that I need to know.
Which she does often.
If you have, say, a pension, a private pension you're paying into, is it worth increasing your contributions to that private pension when you actually, say, have credit card debt or loans? Would it make more sense to clear your loans first, or does it make more sense to top up your pension, or does it really not make any difference? Does it depend on your circumstances?
So this is a difficult one. It very much depends on what debt you have and what interest rate you're paying on it. So if you have credit card debt, but it's on a 0% interest, then it's free debt. You're not paying anything to have that debt there. Obviously, try not to get into any more debt, but ultimately it's free debt. And as long as you're chipping away at it and you're paying it off, that's great. But there's, your minimum repayments is obviously key to be making. Obviously, paying into investments and pensions is more important than investments, I would say, in terms of long-term future planning. And you get benefits of tax-free growth, you get tax relief on your contributions and things like that. So pensions are really valuable. But if you're paying interest on debt that is higher than the growth rate you're probably going to be getting on your investments, debt is the one to pay off first. So if you've got loans or you've got credit card debt that you're paying interest on, and it's more than, say, 4 or 5%, because that's probably the sort of return you might expect to get from investments, then your debt is going to be the one to start targeting. But I wouldn't stop your pension contributions completely. It's a good idea to keep your contributions going if you can, and split things 50-50. Do half into your pension and half to pay off debt that you're accumulating. So there are different ways you can look at it, but that would be what my ideal approach would be.
Yeah, sorry, you're coming off here, Lou. Yeah, right.
Thanks, Glenn.
I didn't want to interrupt your flow. It was going so well. Okay, so when we're then talking about investments, everyone knows what an ISA is and bank accounts and savings accounts, but you then have these more interesting types of investments like bonds and gilts. What are they? What is the benefit to them? I presume a lot of people haven't ever heard of them, and is there a particular reason for that?
So you get investment products, which are things like ISAs and pensions and investment accounts. Those are the products that you're investing in. And within those products, you can invest in equities, which is investing in companies. You can invest in gilts, which are government bonds. You can invest in bonds, which are company bonds. So they're all different things you can invest in once you're invested in an investment product. In terms of what those things actually are, so as I said, a gilt is a government bond. What that means is it's a loan. So if you have a gilt in your portfolio, you're loaning the government money, and they're going to use that to then, try and get the country out of debt, or towards their public spending, and then they'll pay you an interest, and then you'll ultimately get your money back if you do it for a fixed amount of time. And then, the same way it works for corporate bonds. So you're lending the company money so that they can use it and they can fund expansion or growth and things like that. And then they'll pay it back to you along with interest or whatever along the way. So they're lower risk investments because the government or the company are, they're required to return the money to you. Whereas equity is actually buying a stake in a company, and then you benefit from how well or badly that company does. So it's more risky depending on how high risk the company is and what they invest in and what they do. Those are broadly the things you can invest in within those products. You can also invest in property, real estate. That's always good to have some element of property exposure in your portfolio, and cash as well. Cash is a good holding to have when interest rates are high. At 5% at the moment, you can get a good cash savings rate. But when interest rates are low, obviously cash isn't so great. But it's good to have some cash, especially as your emergency fund.
Yeah, sensible. So talking about risk, obviously, when you are investing in or you're paying into a pension, it gets invested into various different types of risk elements, I suppose. If you're talking about, say, something like a stocks and shares ISA as a way to, say, save money, you can pick your comfortable risk with that, whether you go low risk or high risk. Is there much difference to the risk? I presume there's got to be some difference, but is it significant enough to gamble a bit more? Are you likely to lose a lot of money if you go high risk?
So there are times when that you can say yes, but the past couple of years, whether you've been invested low risk or high risk, the losses have been pretty much the same ultimately, because you've had a terrible couple of years. So there are some times where, being low risk or high risk doesn't make much of a difference. But it depends what you're invested in. It depends if you're invested in the right companies that are growing the right way. And if those happen to be high risk areas and you happen to be in a company that's actually having exponential growth, then obviously your portfolio is going to grow a lot more than someone who's invested in a low risk portfolio. So it depends on what companies you invest in. Lower risk investments will tend to have more cash and more bond holdings because they are lower risk, whereas higher risk investment will have more equity holdings, and it would invest more in areas such as the Far East and areas that are just a bit more high risk and new to the market, if you like, emerging markets. It does depend on exactly where your money is invested.
Okay. And then pensions. Obviously, most of us have employer contributions towards our pensions. Nest is obviously introduced as a, sort of cover all employer pension policy, but I believe Nest is not necessarily that great as a pension product. Are there any better pensions out there? So for people that maybe are just paying into their employment pension, would it benefit them to actually set up a private pension? Could they see better returns with a different company, say Royal London or LV or something like that?
Yeah, so in terms of your employer pension, you cannot choose who your employer sets up your pension with. That's the choice of your employer. So you just have to go along with it. The only choice you can make is where your money is invested. So with an employer pension, you'll tend to get invested in a default fund, which is usually a balanced managed investment. It kind of suits most people who are middle of the road in terms of a risk profile. But that might not suit you if you are lower risk, higher risk, or if you're in ethical investments. And there should be an ethical investment option. So if you're invested in your workplace pension, make sure you look at the investment funds and make changes if needed. You can just ask them what funds are available, and then they'll be able to send you the list of funds. Like Claire said, certain providers of workplace pension are not necessarily the best pension providers. If you can contribute more and your company will match your increased contributions, that is worth doing because you're getting more free money out of your company. But if that's not that's not the case, so it's not something they offer, you can set up your own private pension with whatever company you choose, and then you can pay in whatever you want, you can invest it whenever you want, and you can make changes whenever you want. So you get a lot more freedom of it. One also thing to note is with your employer pension, if you move companies, the pension is yours. It's not your company's pension. So if you leave your employer and you go to a different employer, your pension stays with you. So you'll still get your statements, you can still make changes to it, you can still pay into it. You just need to make it a personal pension. But it will remain your pension. You will not lose your pension.
And you mentioned ethical investing. What does that actually mean? Is it a broad brush that applies to, you say ethical investing in every company, it means the same thing, or is it specific to individual companies?
Yeah, so it's a really broad subject actually, and it's one that people are, they're investing a lot more into. There's a lot more research being done into it, and it's an area that's really growing. It's not a one brush is for everything. It's everything sits in a different place. So you can invest in companies who perhaps exclude certain elements such as armaments, tobacco and things like that. You can invest in companies who are trying to improve the planet. So they're building wind turbines and solar energy and things like that. Renewable energy is obviously a big one. There are specific funds you can target if you want renewable energy in your portfolio. So there are lots of different funds you can invest in who target ethical investing in different ways. What we used to call ethical and sustainable investing is now called ESG. So that's ethical, sustainability and governance. So you still get the sort of ethical element of it. The sustainability is more about, not killing the planet anymore and trying to, undo some of the work that we've done to make it the state that it's in. And the governance is more about, how companies operate in terms of internally. So, want to make sure there's no bribery or corruption or anything like that happening at the top of the company that you're investing in. So, so it's a bit more broad now, and it's not as straightforward as it used to be, but it's come a long way, and there's definitely more improvements to come.
If something like that is really important to you and you want ethical investing, do the interest rates or the risk connected with that ethical investing change significantly from normal investments, or does it not make any difference?
It doesn't really make any difference. Maybe 5 or 10 years ago, there wasn't that much choice of ethical funds, and so you didn't get a lot of choice, and they didn't necessarily perform as well. But these days, there are so many ethical funds, you can invest in them, and there are occasional times when they don't perform as well, such as in 2022 last year, with obviously gas companies, BP and Shell made massive profits last year, and investments had a pretty poor year across the board. That's just because of the situation we were in with Russia and Ukraine. But generally, ethical investments do perform as well as conventional investments, and they're just as well charged. They're not more expensive, and they perform well. You get good exposure to different areas, and ultimately, it's an area that the government are investing a lot more time in, and so really we should see more progress in that area, and I think moving forward it's definitely a place to be. I've certainly got my pensions and investments invested in ethical investments.
I wouldn't expect anything less, of course. For the self-employed people out there who obviously don't have an employer-based pension, if you did not set up any pension plan yourself and you only relied on your state pension, for people of our generation, what pitiful amount will we receive from our state pensions when we retire?
The state pension's pretty good. It's about 11.5 grand a year, or that's what it's meant to go up to from April, depending on if the government approve it or not. As a starting point, it's not bad.
It's not bad.
Obviously, for you and I, we can't get our state pension until we're probably about 68, and actually it'll probably
70.
be more like 70. Yeah. We've got a way to go to get there, and the state pension might well change a lot between now and then. There's no guarantee they won't change how it operates, and so we can't rely on that to be what it is today. It can change a lot depending on what government comes in and what changes that they make, so it's not something you can rely on. Self-employed people, I would definitely suggest you set up your own personal pension and you pay into. You get tax relief on payments that you pay in, and it has the effect of reducing your taxable income, so you pay less tax, and who doesn't want that? If you're a limited company rather than a sole trader, you can pay company pension contributions out of your company, and that brings your profits down in terms of corporation tax. You can get tax relief that way if you're paying company pension contributions, so it's definitely worth doing.
And then you told me something very interesting the other day about your national insurance number, and the fact that the letter, something to do with the letter that your national insurance number ends with, has something to do with your pension.
When you get your state pension, the letter at the end of your national insurance number dictates what day of the month you get your pension paid.
But it's like, you and I are going to get paid on different days then, aren't we?
Yeah, mine ends in a...
Yours was an A?
Mine's a B.
Oh, so you're getting paid before me.
Yeah, because you're older than me.
I'm older, so I should get paid.
Minutes, but still.
100%. Yeah. Okay, so state pensions aren't that bad. I think they probably have a bit of a bad rep.
I think just people don't think they're that good.
Yeah.
But really, you know, I mean, a basic income of 11.5 to 12 grand is not bad, is it?
Not doing anything.
If you're not doing a lot, I mean, it's meant to keep pace with inflation, which is why it goes up each year. The triple lock as well is something that's increased it. So the triple lock is something the Conservative government brought in that guarantees that the state pension will go up by a minimum of 2.5%, CPI, or the average earnings index. And obviously with inflation being at the level it has been the past couple of years, the state pension's got a really good boost. But the triple lock is not going to be there forever, and it probably will end at some point, maybe sooner rather than later. So the state pension may plateau, or it may just go up by a fixed rate of 2.5%, or it may just go up with inflation. And if inflation is severely low, then obviously you're not going to get any increase whatsoever.
But it should go down.
It shouldn't. It doesn't mean it won't.
Okay.
You know, we'll have to wait and see.
And presumably then, if the Conservatives don't end up back in power at the next general election, it might be that we don't get that triple boost anymore.
I mean, who knows what next year's going to bring? We've got the UK election, we've got an American election on the cards as well. So we'll have to wait and see what happens. Next year could be an interesting one. But yeah, the Tories they've had a go, haven't they?
Well, so the practicality then, say we get to 70 and we've worked for our entire lives and we finally get to retire. Do the government just start paying me my pension? Do I have to do anything to get my state pension?
So a good thing to do is actually get nearer to retirement, either log on to the government gateway and find out what entitlement you've got, because you need to have 35 years of national insurance contributions to get the full state pension. If you have at least 10 years, you'll get some sort of, you know, payment, but you won't get the full amount. So you can log on online at any point and you know, even now do it and see what you've got and work out how many more years you've got to pay. And then, once you get closer to retirement, to your state pension age, you know, the government should write to you and let you know. But there's an option to defer it. You don't have to claim it. You can defer it. So if you're, for example, you're still working and you don't need your state pension, you can say, look, I don't need it right now. I'm going to defer it. But it's not very beneficial to do so anymore. You used to get a really good boost if you deferred it for a couple of years. I think you got about a 10% boost per year on it when you deferred it, and then you can either take it as a lump sum or you could boost your pension by the amount you've accrued. But now the deferral is not so great, so it's almost always advisable to just take the pension even if you don't need it, because you know you can stick it in a savings account, you can stick it into an ISA, or pay it into a pension and get some tax relief on it. You know, there are tax efficient options for it.
Well, also, you know, I'm not really thinking about getting my state pension anytime soon, but I was speaking to our mum the other day about benefits in deferring your state pension and actually how your state pension works. Is there a limit? Does it only last you for 10 or 20 years of your life? But I understand it doesn't. Once you start claiming your state pension, it carries on paying you till you die. If you live until you're 200 years old, it will carry on paying.
Yeah, the state pension it's for life. So it pays you out for life. They can't stop it. You know, it's something that you're entitled to. It's a state benefit. But it's an interesting one. So the state pension is actually paid for by national insurance payers. So you think the national insurance that we pay, Claire, we're not putting that aside for our state pension.
No, that's paying
We're
funding
pension. Our mum's state pension. So that's the problem we're in at the moment. Because the baby boomer generation are reaching retirement, there aren't enough workers paying national insurance to fund the state pension that the baby boomers need. So we're in a bit of a disconnect at the moment in that, you know, in those numbers. That's why the state pension might change quite significantly in the next few years, but we'll have to wait and see. There's been no murmurings about it. The triple lock, as I said, will probably go at some point, but we'll just have to wait and see.
The same would be true for us by the time we actually get to retirement age. It's not us being paid from our nice little pot we've regularly paying into. It will be your kids that will be fronting our state pensions in whatever state they will be at the time.
Exactly. As it currently stands, our state pensions will be funded by the working generation who are paying national insurance contributions at the time that we retire. So that is what that looks like at the moment.
Okay. And then is there anything, say, in the next 12 months or 2 years, is there anything that you would recommend people do? Maybe, obviously a regular review of your finances is always a good idea, but with interest rates maybe settling or starting to come down, is there anything particular you'd recommend? Obviously Christmas is around the corner, so everyone's going to be strapped for cash. They'll be racking up debt left, right and centre. So maybe in February, after the cold January and the debt-ridden January's gone, is there anything you'd recommend people specifically did next year?
Well, one thing you can do while interest rates are high, if you've got savings, look at what interest rate you're getting, and if it's rubbish, move them to a better account. Even on an easy access account, you can get up to 5% on an easy access account, and that means you can get your money out whenever you want. So that's a bit of a no-brainer in my book. But if you're willing to lock your money away for a year or more, lock it away now, and you can get almost 6% on money. And as long as you're not going to need it in the next 12 months, then it locks it away for next Christmas, and then you can release it for next Christmas. So it's like future funding for next Christmas. So interest rates is definitely something on cash. that's good at the moment. So it's been rubbish for the past few years because interest rates were so low. Because they are high at the moment, that's one good thing, is to try and lock in some good interest rates on your savings especially. And yeah, as Claire said, you know, review your finances at least once a year, check your protections all up to date, so make sure you've got your mortgage covered, you've got your life cover, you've got your income protection at the very least. So you know, you've got cover if you die, obviously, or if you can't work because you're sick, make sure you've got cover there so you can at least meet your bills and your outgoings and things like that. So those are really important, and obviously those are all things I can help with. So let me know if you want help, and I'll gladly have a chat with you, and I can send you some quotes over, no charge whatsoever, and yeah, you can get an idea of what that will cost you.
And speaking of that, something we've spoken about before is the critical illness cover, the extortionate cost of critical illness cover, whether it's worthwhile even paying for, because my limited knowledge of such insurance policies is critical illness cover is separate to those policies that you just mentioned. And it's something, whenever you move house or you get a mortgage, your mortgage advisor talks you through all these pension policies, and critical illness they don't really push it so much, presumably because it is so ridiculously expensive. Is it worth it?
Critical illness cover is one of the most expensive insurances because it pays out not when you die, but if you get a qualifying critical illness. So that could be cancer, stroke, multiple sclerosis, you know, a whole load of things. Each provider covers different things. So you need to check with the provider that it's going to cover what you want it to cover. But yeah, it is expensive because you're more likely to claim on a critical illness cover policy than you are on a life policy, because the likelihood is you're going to get some sort of illness before you die. So that's why it's so expensive. I speak to a lot of clients who ultimately take out income protection instead because it's cheaper. Now, they're very different. Critical illness cover pays you a lump sum. So if you say you get cancer and you can't work or whatever, and you're having treatment and you qualify for the payout of critical illness policy, you get a tax-free lump sum amount. So you can do things like clear your mortgage, or, you know, put things in your house if you're going to need to have assistance around the house. Income protection pays you a monthly amount as an income replacement. It's usually about sort of 60 to 70% of your earnings, because they need to give you some incentive to go back to work. Okay. So if you don't have a critical illness policy, and so you haven't got your mortgage cleared, income protection can pay you a monthly amount so you can keep making your mortgage payments or your rent payments, and it works in a different way. And if you're off long-term sick, your income protection policy will just pay out every month until you either go back to work, the policy comes to an end, or you pass away. Yeah, so critical illness policies do have a place, but yeah, they are expensive, and income protection is cheaper. So it can be just a different way to cover yourself by having income protection instead of critical illness. But if you want to cover all your eventualities, you should really have both.
And is it something, say, as you get older, critical illness cover might be something you consider as well? Because awfully, generally, as you get older, that's when you're more likely to be diagnosed or come down with something. But then presumably that makes it a more expensive policy anyway, because the risk is higher.
Yeah, exactly right, Claire. So obviously, as you get older, you become a bit more aware of your mortality and things like that. But with any insurance, the older you get, the more expensive it is when you take it out, because obviously you're already probably going to have some ailments that need to be considered in the underwriting stage. But also, yeah, you're more likely to be an age where you encounter an illness or an injury or things like that. So the younger you are when you take out critical illness and life cover, the cheaper it will be, because the insurance companies are banking on the fact that you'll be nice and healthy and live a long, long life, and they'll get all your insurance premiums of, say, 20 or 30 years before they need to pay you anything out. Whereas if you take it out later in life, they're banking on the fact that you probably won't pay them much before they have to pay you out the payout. So that's why it gets more expensive the older you get.
Got you. And I suppose my final question, because I can't really think of any more, are there any particular products or particular bank accounts or interest accounts or pension providers out there at the minute that you know are offering a particularly good deal for interest rates or anything like that, or any good 0% interest rates on credit cards? I sign up to the Martin Lewis emails and regularly get sent emails about all the best rates, and that you can get 0% credit cards until 2026 and the like. But is there anything you would particularly recommend people look into, or does it just change so often that you can't possibly make a daily recommendation?
Yeah, so obviously I'm not endorsing anyone in any particular way. I'm not affiliated with anyone. These are all just rates that I've seen. So Martin Lewis, I agree, Claire. I sign up to him as well. If for credit cards, have a look at his website, because they'll do a soft search on your credit score as well and let you know what cards you're going to likely qualify for. So if you're looking for a credit card, definitely go and check him out. In terms of interest rates on savings, there are some names. Shawbrook, that's SHAWBROOK. They offer ISAs and savings accounts that they score pretty highly on the interest rate scale. Certainly I've got an ISA with them that pays really well. So go and check out their current ISA rates. And another one is Synergies, that's CYNERGY. So again, they tend to score quite highly in terms of savings rates and things like that. But definitely shop around. I mean, yeah, like Claire says, Martin Lewis is great, not just for credit cards, but for interest rates and savings too. He's got plenty of articles that they update them all the time with the best rates. So yeah, if you're looking to do things yourself and you just want to find out the best rate at the time, just go and check out his website.
Oh, well, thanks.
My pleasure.
Until next time. Bye.